First, let's look at artificial intelligence. We are building data centers at a rate that is terrifying power grid operators. Global IT power capacity has hit 50 gigawatts this year. That is a 53-fold increase since 2000. Every single one of those AI servers requires silver. It's in the connectors, the bus bars, the thermal interface materials that keep those NVIDIA chips from melting. You cannot thrift it out. If you use copper, you lose efficiency. In the AI arms race, efficiency is everything. They will pay $70, $100, $200 an ounce, because the silver cost is a rounding error compared to the value of the AI chip. Second, solar energy. The solar industry is a black hole for silver. New solar technologies like TOPCon and HAT cells use 50% more silver than the old panels, and we are installing these panels by the gigawatt. Here is the trap. The supply of silver is inelastic. 72% of silver comes out of the ground by accident. It is a byproduct of mining lead, zinc, and copper. Miners cannot just turn on more silver production. If the price of zinc falls, a zinc mine might close, and guess what? We lose the silver production too. So you have demand that is exploding, AI plus solar, and supply that is stuck in the mud. This is the green vortex. The more we try to transition to green energy, the more silver we consume. The more silver we consume, the higher the price goes. The higher the price goes, the more investors want to buy it as an asset. It is a feedback loop from hell for the short sellers. And on Christmas Eve, that loop just tightened around their necks. While the physical market is screaming shortage, the monetary market is screaming debasement. The Federal Reserve has officially blinked. By cutting rates 3 times this year, despite inflation sticking at 3%, the Fed has admitted something they will never say in a press conference. They cannot afford 2% inflation. With U.S. debt spiraling and interest payments on that debt consuming the federal budget, they need inflation to burn away the real value of the debt. This is called fiscal dominance. The market knows this. That is why the U.S. dollar index, DXY, has crashed 10% this year. That is why we are seeing the barbell strategy become the consensus trade for 2026. What is the barbell strategy? It means you dump the middle. You dump the risky corporate bonds. You dump the long duration treasuries that get eaten by inflation. You put your money in 2 places. Cash equivalents for liquidity, hard assets, gold, silver, Bitcoin, for insurance against the system. This is why gold is at $4,500. This is why silver is at $72. It is a vote of no confidence in the fiat currency system. When Treasury Secretary Scott Bessent hints that a new normal for inflation might be 3%, he is telling you to buy hard assets. He is telling you that your savings account is going to lose purchasing power every single year, by design. Silver is the highest beta trade in this environment. It moves like gold on steroids. When the dollar dies, gold rises. When gold rises, silver sprints. Let's get into your head for a second. Let's talk about the psychology of this moment. Why does this feel different? Why does $72 feel like the start, not the end? Because of trust, or rather, the lack of it. The Christmas Eve Massacre narrative works because it taps into a deep, visceral trauma in the market. Traders remember December 2018 when the market collapsed on Christmas Eve. They remember the liquidity crunches. But this time, the massacre is happening to the establishment. It's happening to the naked shorts who sold paper silver they didn't own. There's a retail movement, the Silver Apes, the Wall Street Bets crowd, who have been stacking physical metal for years, waiting for this moment. They feel vindicated. They are not selling. In fact, at $72, they are buying more. This creates a supply shock combined with a seller's strike. If you own physical silver today, are you going to sell it back to a dealer for paper dollars that are losing 3 and 4% value a year? No, you are going to hold it. The dealers are reporting that nobody is selling. The secondary market and the recycled silver has dried up. And then there is FOMO, fear of missing out. When silver broke $50 in October, it woke up the sleeping giant. Now that it has broken $70, the mainstream media is finally paying attention. When your Uber driver asks you about silver, that's usually a top signal. But we aren't there yet. We are just at the stage where the institutional money is realizing they have zero allocation to this asset class. Imagine if just 1% of a major pension fund moves into silver. The market isn't big enough. It would send the price to $200 overnight. That is the singularity. The market is too small for the money that wants to get inside. So where do we go from here? What happens when the markets reopen fully after Christmas? The technical analysts are pointing to $85 and then $100 as the next major magnets. The OLRP, cup and handles pattern on the 45-year chart, one of the biggest chart patterns in the history of finance, has officially triggered. But charts are just lines on a screen. The reality is physical. Watch the backwardation. If that spread between spot and futures stays wide, it means the shortage is getting worse. Watch the Venezuela blockade. If the US Navy boards the Bella 1 or fires a shot, oil will spike and silver will follow it as a war hedge. Watch the LBMA inventory reports. If those stockpiles drop below 100 million ounces, we could see a force majeure, a moment where the exchange says, sorry, we can't deliver your metal. Here's some cash instead. If that happens, if the paper market defaults, then the price of physical silver becomes blue sky. It becomes whatever the holder demands. December 24th, 2025 wasn't just a good day for silver. It was a structural break. The paper age is ending. The asset age has begun. Merry Christmas. Hope you got some silver in your stocking. Stop what you are doing. While the rest of the world is distracted by holiday travel and last-minute gift wrapping, the global financial system just suffered a structural fracture that historians will be writing about for 50 years. It is Wednesday, December 24th, 2025, Christmas Eve. But on Wall Street and in the war rooms of Washington, they are calling it something else. They're calling it the silver singularity. This morning at 08:30 Eastern Time, the United States Navy and Coast Guard effectively lost a high-stakes game of chicken in the Caribbean. The oil tanker Bella 1, a ghost ship carrying millions of barrels of sanctioned Venezuelan crude, refused to heave to. It defied a direct intercept order from the USS Gerald R. Ford. And in that moment of hesitation, the geopolitical risk premium for the entire planet just repriced instantly. Look at your screen. This isn't a glitch. Silver just smashed through $72 an ounce. That is not a typo. In a holiday-shortened session with thin liquidity, silver didn't just rise, it teleported. The gold-silver ratio has collapsed to 62. The algorithm bots are screaming. The bullion banks are silent. Why? Because the market just realized that the paper promises trading on the COMEX are worthless if the physical metal isn't there to back them up. For 45 years, they told you silver was just an industrial metal. They told you it was poor man's gold. They told you the price was set by men in suits in London. Today, those rules evaporated. Today, the price is being set by the sheer, terrifying scarcity of atoms. The Bella 1 incident was the match. But the fuel? The fuel has been piling up for 5 years of deficits, massive AI energy demands, and a Federal Reserve that has quietly admitted defeat on inflation. In the next 20 minutes, we're going to do a forensic autopsy of this breakout. We're going to expose the silver singularity, the mathematical point where the supply curve goes vertical. We're going to talk about the blue chip thesis that predicted this exact moment. And we're going to show you why $72 might actually be cheap. This is the Christmas Eve massacre of the short sellers. Welcome to the new reality. To understand why silver is exploding, you have to look away from the charts and look at the ocean. Earlier this month, President Trump signed an executive order establishing a total and complete blockade of Venezuelan oil. He designated the Maduro regime as a foreign terrorist organization. This wasn't just sanctions, this was kinetic. This was park a carrier strike group off the coast diplomacy. The market ignored it until today. The Bella 1 incident is the signal that the blockade is messy. This dark fleet vessel, flying a false flag, basically dared the US Navy to fire on it. And we didn't. The vessel escaped into international waters. This tactical failure sent a shockwave through the algorithm trading desks in New York and London. Why? Because it signals asymmetric warfare. If the US cannot easily stop a tanker without starting a shooting war, then the supply chains for everything, oil, copper, and yes, silver, are at risk. The war premium is back. But here is the psychology of what's happening right now. Panic accumulation. When geopolitical fear hits, money doesn't just move, it flees. It flees from paper assets that can be frozen, sanctioned, or defaulted on. It flees into assets that have no counterparty risk. Russia, China, and Iran are watching this blockade. They see the weaponization of the dollar and maritime law. Their response? Buy physical commodities, hoard them. Do not leave them in Western vaults. This morning, we saw aggressive buying from the Asian Open all the way through the London fix. This wasn't retail traders buying coins. This was sovereign-level accumulation. They are draining the float. They are buying the Bella 1 headlines, but they are staying for the structural shortage. And that brings us to the real story, the story the banks don't want to talk about. The singularity. It sounds like science fiction, but it's actually a brutal economic concept. It refers to a moment when the paper price of silver, the futures contract, and the physical price of silver completely divorce because there is no metal left to deliver. We are seeing evidence of this right now in a phenomenon called backwardation. Normally, silver futures cost more than the spot price. You pay extra to have silver delivered in the future because you have to pay for storage and insurance. That's called contango. It's a healthy market. Today, the market flipped. The spot price is trading higher than the futures price. At one point today, the spread blew out to $2.88 an ounce. Do you understand what that means? It means industrial buyers, companies like Samsung, Tesla, First Solar, are panicking. They are saying, I don't want a promise of silver in March. I need the silver now to keep my factory running, and I will pay a massive premium to get it. They don't trust the COMEX to deliver. This validates the blue chip thesis that has been circulating on institutional desks. The thesis is simple. The market has been in a structural deficit for 5 years. We have consumed nearly 800 million ounces more than we have mined since 2021. We have eaten through the above-ground stockpiles. The London Bullion Market Association, LBMA vaults are running on fumes. The free float, the metal that is not already leased out or owned by ETFs, is estimated to be critically low. We saw lease rates spike to 39%. Imagine paying 39% interest just to borrow a bar of silver for a year. You only do that if you are desperate. You only do that if you are a short seller who is trapped and can't find the metal to pay back what you owe. This is the squeeze. It's not a Reddit meme. It's a supply chain heart attack. Now, let's talk about why the demand is so relentless. Why can't we just mine more silver? 2 words: inelastic demand. Silver is no longer just money. It is the lifeblood of the future. It is the most conductive element on the periodic table. You cannot build a high-tech society without it.